good. I'm Yelena Edelstein. I'm deal partner at Blackmore Partners. Thank you very much, everyone, for participating in this conference. Special thanks to our panelists, and we'll start with your introductions. Please introduce your firm, yourself, and please mention if you attended this conference before. Please be brief because we will be exploring your firm during the panel. So please, we can start with Alex.
Yeah, absolutely. This is, I'm not sure how many I've been to, but it's at least, I don't know, it could be 5 or 6 now, conferences that I've been to.
Right.
And it's definitely been great and a great resource for us over at Union. So my firm, Union Capital, we've been around since 1968, really a generalist fund, but we don't do much in tech or healthcare, but a lot of food manufacturing, specialty manufacturing, business process outsourcing, marketing services, franchises, and staffing. I'm Director of Business Development at Union, and I've been working with the guys there for about 8 years now, yeah, excited to meet some of the executives here and learn their stories.
Sounds good. Thank you, Alex. Lawrence, please introduce yourself. Lawrence, can you hear me?
Oh, you said Lauren. Yes, good morning. Lawrence Litchfield, Columbia Pacific Advisors. This is my first Blackmore Connect. Columbia Pacific is based out of Seattle. We do a number of different things. Technically, I work within the alternatives group, which has about $3.5 billion of assets under management. And my focus is on direct lending, providing flexible private debt solutions to lower middle market companies.
Thank you. Emmett, please introduce yourself.
Sure. Good morning. My name is Emmett Mosley, and I'm with KCM Capital, which is a private equity firm out of Chicago. I've been in the private equity space, I guess, a little over 22 years now, and I think this is my 3rd Blackmore or so event. Known Gerald and Yelena for a number of years, and look forward to meeting many of you and talking more about opportunities and how we can work together.
Thank you. Jessica, please introduce yourself.
Good morning, everyone. I hope you can hear me okay. I'm not sure if my speaker
Yes, we can.
It's full volume.
Good.
Okay, fantastic. I'm here in Chicago. I work with a fund called the Edgewater Funds. We're a low middle market private equity fund that was established back in 2001. We manage more than $2.7 billion of capital. We're investing currently out of our 4th fund, which is $1.1 billion, looking for executives to work with to help us execute senior leader executive led buy and build strategies. So excited to meet everyone and learn more about everyone's interests.
Thank you so much. And John, please introduce yourself.
Yes, my name is John Newman. I'm principal in business development for Capital Partners, a Norwalk, Connecticut-based private equity fund. I actually sit in Cleveland, but the firm is based in Connecticut. We're currently investing out of our 3rd fund, which is a $600 million fund. Also generalist investor, but generally focused on manufacturing, industrial and business services, some food manufacturing and consumer goods as well. I'll leave it there if we're going to go into more detail later.
Okay, I saw Joe pop in. Are you on this panel, Joe?
I am not. I was trying to join the opening remarks, but I was having some technology issues. Did I jump into the wrong meeting?
You're late, Joe.
You're just late. It's all right, no problem. Which panel are you on, Joe?
I'm on panel 3.
Okay, good. So camera off and to your panel.
I'm sorry?
Yeah, no worries. Just camera off to you till your panel comes on, okay?
Okay.
No worries.
We'll see you soon, Joe. All right, so the title of the panel is How to Pick the Right Private Equity Partner. But before we get into that, we always start with a question to the panelists. What do you look for in the investment thesis? As you know, all executives attending the conference prepared pretty detailed investment thesis. I want to hear from you. What do you look for in this thesis in terms of market, the target, value creation, executive experience, other things? So we'll start with Alex.
Yeah, absolutely. No, it's a great question. I think we, specificity, I think, is really helpful, and particularly on the markets that you're going to be targeting or the areas you're going to be targeting. I think, if they're active individual targets you have, then the value creation side is definitely helpful. Or if there's sort of macro things in industry that you've identified that you think you can improve in individual business, that's great. But overall sort of assumption of value creation, without some backup sometimes is not as helpful as a real sort of deep dive market view. So that's sort of how we look at it anyway.
Yeah, Lawrence, from your perspective, you've read the thesis. What maybe some things you can mention that seemed really relevant and some are not?
Yeah. So we kind of broadly speaking, we don't really have any industry focus. We're industry agnostic. We're also nationwide, so no geographical focus either. I'd say when we're looking at a potential opportunity, the people involved are one of the most important things. And so an operator.
What are you looking for?
An operator who has a diligenceable background and a demonstrated success and demonstrated ability to execute a business plan.
Diligenceable, what does that mean? Can you be more specific?
Yeah, that means we can actually look into it and verify it. Sometimes that's difficult.
How does one do that? How does one do a reference check for that?
So there's a company we work with for kind of background checks, and those are very thorough. But more so than that, it's around, we can use expert network resources. If, let's say, they were leading a kind of a smaller company in a niche industry, or if they were at a larger company, we can also kind of tap some resources there, and obviously they can provide references as well.
Okay.
And Lawrence, does it mean that for you, the executive must have directly relevant experience, the same industry, the same kind of situation, the same plan?
Not necessarily. I think there should be some kind of adjacencies and carryover, but it's not. It's not like they need to have previous success in a given niche industry.
So the track record must be the verifiable, I guess. A track record must be the most important, right? And are you looking for certain growth patterns, or if it's a turnaround, results from that? What exactly are you looking for? The kind of maybe metrics you can share with us?
So we, I'd say every deal we look at where there's an independent sponsor involved, there's obviously a growth plan, and yeah, there's a dynamic where whoever controls the equity sees a lot of upside over the next, say, 2 to 4 years. And we can provide a solution that helps them, the entrepreneur, the owner operator, helps them achieve those objectives and fully appreciate those economics.
Sounds good. Thank you. Amit, what are you looking for in thesis?
Yeah, I think a lot of what Lawrence talked about is pretty important. People drive it all. The executive drives, 90% of the strategy. I think the one thing I would add is just the targets are pretty important, because you can have the best thesis in the world and the best ideas in the world, but if you don't have targets that are interested, that you could acquire at reasonable valuations, you could find yourself spending a lot of time in the what if world. So I think it's important to kind of have a really good balance and make sure, you kind of get a sense of what the interest levels are on, in your targets before you spend too much time diving in, spending, time putting together 50-page thesis with all these color charts. Because again, if you can't identify or find the right target, it could be all for nothing. And unfortunately, I've had way too many of those episodes in my career. So
that's how we all learn, right? Emmett?
That's
Right.
We learn from that.
Yep, exactly.
What does it mean to have a reasonable, I think you said reasonably priced or a reasonable price expectation. What does it mean to you?
That's a really good question. I think it's kind of like beauty. It's like beauty's in the eye of the beholder. But I think you generally try to start with the public comps to the extent they're available. Obviously you're not going to pay those type of multiples. You try to get information from companies, which is challenging when they're privately held. But the more information.
Let me add something, Emmett, about public comps, because what Emmett, I think you're talking about is a public comp is what someone who can borrow public money can pay, and those are typically higher because they're strategic investors. Yes, or no?
Yes. Yeah, pretty much. I mean, they're obviously in the public markets, and so the trading and the capital is just a little different game than in the smaller, privately held businesses. So yeah, you just a lot of times there's company owners that kind of view themselves as more valuable than like a Johnson & Johnson we've seen before. They tell us they're a better company, better run, and they deserve a higher multiple. And it's just, at the end of the day, it's just you gotta, time is just something you can't get back. So you gotta be very careful and treat it very precious in how you spend it, just because once it's gone, it's gone. So I would just say the target piece is very, very important to add on to what Lawrence talked about with the executive.
Oh, good. Thank you, Emmett. Jessica, please introduce. I'm sorry. Please tell us what you're looking for in the thesis or from the executive.
I think to elaborate on Emmett's point, it's kind of the actionable targets, but I think beyond that, having a good understanding of market segmentation. Is it truly a fragmented market, or is it comprised of a small number of big players? Because we're really looking to execute a buy and build, and in order to do that, you need a lot of kind of smaller players to go after to build scale. So that's what we look at, is truly the market segmentation.
Jessica, what do you find attractive in fragmented market as an investor? Why? And maybe there are other characteristics like growth.
Yeah. So market fragmentation allows you to create scale at a relatively inexpensive way. So we can acquire a platform company, and we currently start around the 5 million EBITDA mark, and then acquire add-on acquisitions in a more fragmented market more easily at a lower multiple than that initial platform. So that's why it's attractive to us, is because we can then dilute down our blended multiple by acquiring add-ons. So that's what we really think about when we enter a new strategy is, again, like what's truly actionable. And I know that a lot of us here have done that kind of work before we even close on the initial acquisition of what does the pipeline behind this initial investment look like.
Yeah, I was going to ask you, are you looking for multiple actionable target at the same time, or you're looking for kind of semi-actionable maybe pipeline? Both.
Yeah, I mean, again, we've all been out there trying to execute on this, where you build out a pipeline and you have a probability of any one of those deals closing, and so you have to have a number of different prospects to pursue to really get any one deal done. So, and then obviously they are attractive for different reasons, some of which fit better with your platform thesis, some of which don't, but it's really building a solid pipeline so that you can create scale within a reasonably short period of time, a couple of years. We're looking to double or triple the size of the company. So, but that's important for us as we think about thesis.
In this kind of strategy, are you looking for first a platform company and then maybe smaller add-ons? Is that the idea behind your strategy?
Right.
And so, for a platform, what characteristics should it have?
Well, we like to start with a company, again, with some scale. So again, around 5 million EBITDA. We like a lot of the same characteristics that a lot of private equity is looking for: customer diversification and market diversification, vendor diversification. If we're talking about the investment thesis, or thinking about, is this a sector that we're comfortable with? Is it cyclical? You know, is it going to respond well during the next pandemic, which I don't think any one of us would have asked, you know, 6 months ago. But
That's great.
but you know, a lot of those basic kind of, you know, investment pros or characteristics that we're all looking for in a company are certainly going to play out. And then something with scale with a really good team. You know, we're willing to come in and subsidize a team and bring in C-level leadership, but we like to back a pretty solid team to start. And then
so you want the team to stay. You're not looking for a platform where the owners are retiring. What you're preferring, it seems to me, the team you.
It's a really case-by-case basis. We have looked at businesses where the CEO or the owner is really looking to exit entirely, and we have someone that we could plug and play. It's a case-by-case basis, but you know, we like to really back solid management, and so to some degree we can work around the interest of management. But if there's one guy kind of leading the show and he can't even take a day off for vacation because everything runs through him and he's the one exiting, it's going to be hard for us to get excited about that.
Sounds good. But one last question, and I'm really into this topic because I noticed multiple executives are working on thesis similar to what you're describing. So the last question to you, Jessica, is what kind of expertise, experiences do you look for in the executive who presents to you such a thesis, such a deal?
Yeah, I think, you know, I heard from a number of the executives that spoke earlier, their backgrounds as to kind of the P&L that they've run before. That's certainly interesting or of interest to us. I think if they've executed M&A in the past, that's certainly interesting because that's
integration.
one of our primary initiatives when we do close on an investment is M&A. And I think I even heard another executive speak about how he's worked with other private equity historically, and he has maybe two case studies where he built businesses and exited. So that's certainly really attractive. But I think that each executive probably has their own area of expertise, and that's what they really should kind of focus on, is what their value is to the investment.
Sounds good. Thank you so much. John, anything you can add to what's been discussed from your perspective on the thesis, on the executive experiences? John, can you hear me?
Is that to me? Yeah, you cut up a little bit there. So what was the specific question? I apologize.
Just wanted to know if you'd like to add to what the panelists were talking about, what they're looking for in the investment thesis and the executive experiences.
Right. Well, it's going number 5 after the other 4 have spoken. I could just go with ditto, I suppose. But maybe to add on to what Jessica said, we're very focused on backing existing management. So I'd say, well, maybe the first thing is, does it fit with us? Does it fit with our focus? And as Alex said, we're not healthcare guys, we're not tech guys, so some verticals are not going to fit. Then it would be, is it an actionable idea? It might be a great, thesis, but if there's no dialogue with potential opportunities, then it's just a thesis. And then number 3, I'd say management team. If the idea is, I'm going to buy a broken company, and the CEO's going to move to Florida, I'm going to become the CEO, and I'm going to fix the company. That's for many private equity firms. That's probably not one for us. We're very focused on sort of backing existing management teams. So if the idea is it's a good management team that maybe the ownership hasn't invested, and the idea is to bring better sort of oversight and investment into the company, then that's one that fits with us pretty well. Again, not to make judgment on different ideas, because there are, even though from the outside looking in, every private equity firm probably looks the same. That's not really the case, and there are plenty of opportunities out there that just fit with different private equity firms.
Yeah, that's a very good point. All right, so we'll start on our main topic. John, I will start with you this time. Talk about your firm in terms of how it differentiates. What kind of really investments are you making? Are you more operationally, financially focused? Is it, how do you treat the leverage? I mean, all the kind of important things that you kind of look in post-transaction activities. Again, what you said is very interesting just now, that on the surface, private equity firms look very similar, but in reality, really, there are specific things that you look for in a deal and how you execute the deal, and then how you create value post-transaction. So if you can emphasize those things that are maybe specific to your firm.
Sure. So my perspective, we're sort of 5 to 25 million of EBITDA, but really sweet spot, sort of high single digits to mid-teens of EBITDA for a platform. We're also looking for opportunities for add-ons, but I wouldn't brand us as really a buy and build strategy. Maybe over the course of our ownership, we might make 2 to 4 acquisitions, but it's not like super high velocity. That's not necessarily what we're looking for. From an ownership dynamic, we're used to being first institutional capital, which I'm assuming everybody else on this panel is as well. Where we differentiate ourselves is on structure. So I've told this story many times on these panels, but we under lever. So we max leverage at 2.5 times. It's just senior debt. And then, so we're over equitizing all of our deals. Well, I'll get to that. I'll get to that part.
Okay.
You know, I got to get at my role. You know what I mean? I got my whole story.
Oh, please. Yeah, I won't interrupt.
Good.
So we under leverage, and then on the other side, partly because we under lever, we pay a yield on the equity. So we're basically paying a common dividend targeting a 10% annual yield paid quarterly. And then third, because we're paying a yield, everything that we own is owned in a LLC structure. So most private equity firms put a C Corp when they buy a business. They put a C Corp blocker on top of this, on top of whatever they buy, because they're not focused on current yield. So that structure of under leverage current yield and pass-through entity structure is basically entirely designed to be attractive to the founder owner or entrepreneur who's looking to partner with us. And most owner operators don't like leverage. They like taking money out of their business, and they own it in a pass-through. So that's we try to differentiate on the structure. Yeah, go ahead.
Can you elaborate on why this dividend is important for the owner? You know, how his kind of financial situation changes post-transaction, how the dividend kind of helps, you know, equalize before and after transaction.
Right. So what we try to communicate to an owner is that if he or she rolls equity into our deals, for many, if rolls equity into our, which is for private equity firms when they're buying a business from a founder owner, that's an important aspect, is the rolled equity. Or in the case of an independent sponsor, you know, rolling the fee or putting new equity in. And so in most circumstances, you don't receive a return on that equity until you get an exit. Now, in some cases, there are dividend recap. Those are relatively few and far between. So what we communicate is that on that rolled equity, you're going to get a return on that equity from the very start, you know, a quarter or two into your ownership. Now, it's not, what we're focusing is you get basically a third of your total return via the current yield and 2/3 for the exit. It's not like the exit is unimportant. It's still extremely important and can make or break or does make or break the entire investment. But nonetheless, the current yield is sort of a nice kicker, let's put it that way.
Sounds good. Anything else in terms of differentiation? Sounds
No.
good. And just maybe, so the leverage point is that that's really catered toward the owner, gives you the ability to produce the dividends. There's nothing else that is a reason for low leverage.
Well, I mean, you could say, low leverage gives us a better position in times like this, right? Where as EBITDA goes down, our leverage goes from 1.5 to 2 times up to 3.5 to 4 times. Now, honestly speaking, if it goes to 3.5 to 4 times, that's on an all senior basis with commercial banks. So if we go up to 4 times, we're probably outside of the covenant. So that does result in covenant negotiations. But nonetheless, 4 times senior leverage looks a lot better than 6+ times overall leverage in times like this. So we try to say that our lower leverage approach allows management teams to focus on things other than managing the covenants and managing their leverage.
Perfect, thank you. By the way, any questions from the audience? I haven't seen any. Please be active. These sessions are much more valuable with participation of the audience. All right, so we'll move to Jessica. So you told us a little bit about your buy and build strategy. Is there anything else you can add? The way we should think about your firm, how it differentiates in the market to executives, to business owners?
I would say that about 70% of our portfolio today is truly buy and build. About 30% is more opportunistic, but we'll invest on a minority basis. So we're always looking for those types of opportunities where we can come in as a partner on a flex minority basis. And we're really
tell us more about that? About the minority, it's not very common. It's becoming more common, but still not very common in private equity. And is it new for you? Is it a new strategy for your firm? Maybe you can tell us a little bit more.
Yeah, so it's not new. The first handful of deals that Edgewater closed on back 2001 to 2004 timeframe were minority transactions. And that was really the MO of the founding partners was to cater towards the owner operator and be more flexible than the traditional private equity fund was at that point in time. So we have a lot of experience and we have a really healthy appetite for non-controller minority deals. And we're really about looking for companies with strong growth prospects where we can come in and invest in that business and help accelerate growth. So a lot of times we'll come in and pay out an inactive shareholder, maybe a brother-in-law that has equity is looking to exit, or we're right-sizing the balance sheet or shoring up working capital or what have you. So there are a lot of different scenarios that play out where we can come in and help solve, a problem for the primary owner. But we're really looking for is how can we contribute value outside of that investment? What else can we do to jump in and be like a valuable partner for that owner in the business? So.
Okay, Yelena, we have a question coming in from Scott Hine. Scott, I would like you to ask the question in general, Scott, if you would, by just unmuting yourself. Scott, if you could. Scott Hine.
Sure, not a problem, Gerald. Thanks very much. One of the things that, sort of tweaked my interest, John, in your response was around the payout sort of gradually sort of a third, 2/3 for the executives. How do you see executive compensation at the C-suite level? I'd be interested in hearing the different firms' perspectives on that.
Are you asking how does that result in a lower
no, it's more of
compensation, or do we?
Sure. How do you consider the overall compensation? Sure, I can ask it differently. So if you looked at the overall compensation as a package of value that you thought you were bringing at the beginning.
Yeah,
sorry, John.
Okay, so
I lost you there.
Right. Yeah, so I think most private equity firms are going to be competitive on executive comp. There's going to be a base salary and then some percentage of that base salary achieved through an annual bonus. And then most private equity firms have some type of an option pool that's allocated at the time of either investment, or let's say that the executive is hired post-investment, that's allocated at the time of the hire. And it will be an option pool that has some vesting, has a strike price, etc. We have something similar to an option pool. It's actually a B share plan, where after a particular hurdle, an 8 to 10% hurdle, they actually start to participate in that same current yield that the rolled equity or the A shares participate in. But nonetheless, that's a little bit of a nuance, but most private equity firms are going to have a very similar structure. And I think each of us would say that we're competitive on compensation.
Okay, I think that answers the first question, but I'd be interested in hearing some of the other panelists if they feel the same way, or if they've got other thoughts on how they look at compensation.
I'll speak up. This is Emmett. I think he's right. I mean, I think I've never seen anyone go to another group based on compensation. I mean, I think what John just laid out is very similar to most groups and how they structure it. You know, one thing I'll say is I think a lot of times execs, you get caught up in compensation. You got to remember 30% of zero is zero. So at the end of the day, it's more about picking the right partner and making sure you're with someone that's going to actually add value and build it, because the comp piece is irrelevant if you don't execute on the strategy. So I think the approach really is more like you got to look at these as more of a marriage than anything else. Whenever you partner up with someone, it's much more like a marriage than it is just a transactional relationship. And I think you got to take it that way. And that's how we generally approach it is, it's easy to be a teammate when everyone's scoring, right? I mean, you got to make sure you're with people that when times get a little rougher, there will be bumps. There's very unlikely that anyone on this panel has had portfolio companies that just had rosy 20-30% growth every year and everything's great. I mean, there's just things that happen that no one can see. I bet no one here had COVID-19 in their 2020 budget. So it's just things happen, and you have to make sure you're with the right type of people that you can work together through it, as opposed to a lot of finger pointing. So anyway, long-winded answer, but I think from a comp perspective, things are, as John laid out, at least through my experience, very similar.
I'm curious, would you look at the deal, how attractive it is, how actionable it is when you decide what the compensation is? In other words, the better the deal, maybe the better the compensation package, or not necessarily. Emmett, what do you think?
Yeah, I mean, I think, it's one of those things where, do you want to be an employee or an owner, right? If you want to be an owner, we want you to be focused on the equity, and we want to be completely aligned in making money at an exit. If we win, everybody wins. We want it to be that type of party. If you're more focused on current comp and trying to find a way to make, $1 million a year in salary and bonus, again, if you got a target that's doing 30 million of EBITDA, that's a different conversation than the company doing 5 million. So I think some of it is about it being attractive, but at the end of the day, our goal is to continue to build and grow the business and take that capital and continue to reinvest to grow both organically and possibly through acquisition. So, but there's different strokes for different folks. I don't think there's a wrong way. I don't think if an executive wants to focus more on current comp, that's a bad thing. I just think sometimes it could, just misalign interests with equity groups, because most equity groups are going to make their money on the exit, at least the ones I'm aware of. So.
A kind of similar question. What's your expectation of how important it is that the executive invest his own cash? And if it's important, what size would really matter? Anybody from the panel would like to? Alex, what do you think?
Yeah, absolutely. No, I mean, I think, it's definitely a great sign, if someone is so pro on a particular opportunity that they also want to bring in their own cash. I think, the size, isn't, necessarily meaningful as an absolute dollar amount, but more as a sign of their interest in the opportunity. And I think you'd sort of have to, figure it out depending on what their role would be. Some people are looking to find an opportunity and run the company, and that's maybe a different discussion than if they'd like to find the opportunity, be more of a board member and add value that way. But I think it's always a great sign, but it's not, it's not necessary, to sort of get a deal done.
Right. Well,
I have another
hopefully,
question coming in when you're ready.
Yes, we're ready.
Jay Topper, go ahead, please, and ask your question. Pop in with your video.
Hi there, I'm Jay Topper, and my question is really for any of the panel members, and it's with a lack of ability to travel as much and be in person for due diligence, management presentations, et cetera. How has COVID changed the investment environment, either from your perspective or from the target perspective? More hungry to be acquired, less hungry to be acquired? Just what's the overall environment for your firm given what's going on with COVID?
Very good question.
I could speak to that. So, I mean, I think we've been, sort of very active throughout the coronavirus situation, speaking to business owners, and I think, they probably fall into a couple categories. I think some business owners, rationally are thinking they may be able to wait it out and get a good valuation. But I think, depending on your circumstances, I think it's also very meaningful to think about, do you take some chips off the table, roll a meaningful amount, and then you de-risk and get some upside. So, I mean, I think we've been seeing a lot of interest from business owners and sort of exploring those things, given kind of the uncertain timeline of COVID. I'd also say, from what we've been hearing from lenders and limited partners, if you look across the lower middle market, there's maybe a third of companies that are in significant trouble, a third of companies that are kind of muddling through, and then, maybe 25%, to a third that are kind of flat to sort of thriving given the changes around coronavirus. So, there's a lot of things moving around. I think, it's sort of still too early maybe to tell what the lending environment's going to be like. But although it, to all intents and purposes, it seems like things are open for business, but, I haven't seen too many deals close and
maybe more selective.
Yeah, I mean, I think they may end up being more selective. Now, it's interesting. We don't do a lot in tech or healthcare, but I think, those two sectors, they're either up to unaffected. And when I talk to bankers they're in those sectors, I mean, sort of even through the worst parts of sort of the shutdown, and in March and April, they were sort of working through and closing deals, and it's unlike a lot of other sectors. So it's, complicated picture, but I think there are definitely still deals to be done out there. And, we're working on a few things, and I think, as far as dealing with diligence during the coronavirus, I think,
yeah, I was gonna.
Yeah, we're sort of trying to, sort of move out some of those in-person visits or facility visits to kind of later in the process, and maybe you don't send as many people. But I think, there's a lot of ways to sort of get those done. And we have a lot of team across the country, so more often than not, someone's in driving distance, and so it all works out.
Alex, what's your view on the valuation? If EBITDA was 5 million pre-COVID-19, and now it's maybe half of that. And of course, projections are very uncertain. How do you deal with with the valuation?
No, I think it's a great question. I mean, I saw on LinkedIn, it was a week or two ago, someone had the new EBITDA's EBITDAC with a add back COVID. But I think you know, I think it really depends on how you think about, you know, how you validate their plan to grow out of COVID, you know, and how you can kind of structure, you know, be more creative on the structure to kind of,
Yeah, I was going to ask, what do you find sellers more open to reinvest more, to deferred payment? Maybe there are other ways to kind of structure, or basically sharing the risk, right? Is that what you maybe were alluding to?
Yeah, you know, I think there's a lot of different ways, you know, that you can sort of share the risk there, and you know you could do a minority deal with the opportunity to buy a majority at a later date. Obviously, there's earnouts, you know, there's structure. You know, I think the other thing too is you can, you know, business owners sort of been playing defensive in a lot of sectors, you know, for the past few months, and you know, it's a fun conversation to say, look, you know, what if we back you and you try and acquire a competitor, and that's how we kind of work through this situation. But so I think, you know, and I think it's so sector and company specific. I mean, we have 4 food manufacturing companies, and even in food, you know, we've seen, you know, everything from, you know, we're running at full capacity because the sort of demand has completely changed, to, you know, oh well, look, we need to find new customers in some cases. So it's you know, it's really sort of situation specific, and how much do you sort of believe the you know, the comeback story on some of those things.
Sounds good. Gerald, I see a few more questions. Are we?
Yes, we do. Let's call on Roberto, and then
Alex,
just a reminder, we have about 6 minutes left before we take a break.
Okay, thank you very much. This is Roberto here. My question is about the first 100 days after the acquisition. What are your expectations and experiences? Do you expect a significant change? Do you take time to allow for changes? How is the cultural element taken care of? And to all the panelists.
Well, I know for us, you know, the first 100 days we look at, we have a plan before we close. So there's no surprises. It's not like we're going to try to figure it out after closing. I think it ranges, though. I think it depends on what the strategy is. You know, if the management team, are you replacing the management team? Are you working with the management team to execute that strategy? But at the end of the day, I think for our firm anyways, we look at the culture as one of the biggest assets we're getting. We're investing in a business that has a certain type of culture. You got to talk about EBITDA, you got to talk about revenues, but at the end of the day, there's a group of people that are responsible for producing those results. So, you know, if there's a ton of changes that need, I mean, we're not turnaround guys. So if there's a ton of changes that need to happen in the business, it's probably not right for us. We're looking more to enhance what's been built as opposed to trying to recreate the wheel. So I know we only got a few minutes, so I'll stop there, but I think the plan is usually in place prior to closing on how you handle that.
Thank you. Any more questions, Gerald?
Yeah, John Percival. Go ahead, John.
I just wanted to hear any comments on exit strategies. I've always heard about how private equity generally has a time horizon that they give you, and is it time driven? Is it goal driven if you've achieved a certain return? Any inputs on that? Thanks.
Yeah, I mean, I could speak to that. I mean, I think, you know, most PE groups that are in sort of your more traditional fund structure have kind of a fund designated time to invest, and then a time to sell. So that, you know, is definitely part of that. And look, there are ways to get extensions and things like that, but that, you know, typically, you know, you sort of think about a 5 to 7 year hold period. And, you know, a lot of the thinking around that too is, you know, after 5 to 7 years, in a lot of cases, you know, the team is kind of may have exhausted a lot of the ideas and things that they have tried to achieve. And it's sometimes good to sort of get fresh blood in there to you know, to continue to drive the company forward. You know, I think on you know, at least for us, I mean, we're very opportunistic. I think, you know, we definitely, you know, setting goals and setting, you know, multi-year goals makes a lot of sense, but you may also find, you know, someone makes you an offer you can't refuse. The market is very hot, but I think the important thing is it's always a conversation between, you know, the CEO and the PE fund. You know, I think it's probably very rarely that you know, a fund, you know, sells an asset, or at least in my experience, fund sells a company, you know, with the CEO saying, no, this isn't the right time. You know, you want everyone aligned on that. You know, and I'd also say, you know, sometimes you hear people saying, look, our exit plan is we're going to sell to these three strategics and it's a perfect fit and this is going to be great. And then you kind of get to that time and for whatever reason, the three strategics are, you know, someone decided that year, look, we're not going to buy anything else. And so your, you know, your perfect plan didn't really work out. So I think, you know, it's important to sort of have a company that's going to fit for financial buyers as well. But those just
and nowadays, Alex, what kind of return are you expecting, cash on cash or IRR? What is good nowadays?
You know, we try and, you know, we try and do, you know, maybe around 30% IRR or something like that. I mean, that's always the goal, but you know, I think it really depends on the you know, depends on the opportunity and the risk and how you're structuring it. You know, we're an operationally focused firm, so a lot of things we're doing, you know, we might be buying a company that really doesn't have a management team, or we might you know, be sort of upgrading the whole team or the operations, and so, you know, there's more risk there and sort of a different strategy sometimes than other groups, and so it's sort of depends on how you're kind of thinking about that risk reward ratio.
Sounds good. Gerald, we have a minute left.
We got to stop here, and then I encourage folks to come back and answer their questions if they didn't get answered. We have two more panels. We're going to take a break. It's 11:15. We'll be Central Time, and we'll be back in 15 minutes. So if you're on the second panel, please be ready to go. Blackmore team, please make sure all panelists are ready, okay? 10-minute break, excuse me, 10-minute break, I was just told, 10 minutes. So be back at 11:25, Elena, is when we start, okay?
Sounds good. Thank you.